Okay, I want to talk about Measure 97, which is a tax increase proposition in Oregon that's going to be up in a few days here, 2016. Um, and I don't want to talk about which way you should vote, but what I want to talk about is the mechanics of taxation at the state level. And I want to talk about the mechanics of the taxation of Measure 97. Um, I, yeah. So that's what I want to talk about. This might go a little bit long because there's a lot of things that I want to talk about, and I think it'll be enlightening information. Okay, well, and I'll just give you my up front. I'm not going to vote for Measure 97 because I think it. Well, I know that it taxes the same thing twice. So it taxes income made by businesses twice, and so that's why I'm not going to vote for it. And I'll explain that later. Okay, so let's start at the federal level. At the federal level, you have a few different sources of revenue, taxes. You have the corporate tax, you have the income tax, you have the payroll tax, which is FICA, which you'll see in your W-2 and on your paychecks. And then you have the estate and gift tax. And then you have, finally, the tariffs, taxes on imports. And Donald Trump wants to raise the tariffs. I'm going to raise the tariffs. Anyways, that's my impression. The main federal sources of income, the main two are the income tax and the payroll tax. And those are about 50-50. So when Romney said, half of people don't even pay any taxes, I mean, it's not true. And that's one reason that was a bad statement to make. Poor people actually pay a significant amount of taxes. The taxes are actually pretty fairly distributed at the national level. Okay, so that's the federal system, and then the IRS enforces those taxes, and the state system is different. So the state system, there's three major taxes, and what I've found is each state essentially gets most of their money from two of the three major taxes. So there's the first one is a property tax, and most of the money comes from a real property tax. Real property is land, houses, apartments. Although some states, when I was in Virginia, they had a personal property tax, so they would tax your vehicle essentially. So property tax is the first one. The second one is sales tax. I mean, that's pretty straightforward. And then the third one is either income tax or gross receipt tax. Now, states also have corporate taxes. They have kind of head taxes, basically just a fee for doing business in a particular, doing business or doing some activity. But those are the main taxes. I guess the corporate tax could be pretty high too, but the big three tend to be property tax, sales tax, real property tax, sales tax, and income or gross receipts tax. Okay, so an example. So in Oregon, we don't even have a sales tax. Our primary revenue comes from the income tax and then the real property tax. Those are our two main sources of income. In Washington, they don't have an income tax. They have a gross receipts tax, and that's one of their main two. And then they have a sales tax, and their property taxes are lower, which is one reason a lot of people in Oregon, a lot of people that work in Oregon, my back kind of hurts, so I'm taking deep breaths. Anyway, people that work in Oregon, a lot of times they'll live in Washington because they'll pay a lower property tax in Washington than Oregon. It's like it could be a $5,000 difference a year, so pretty significant. Okay, so Measure 97 is a gross receipts tax, and what that means is the government looks at how much you've collected in revenue, and they multiply that by a percent, and then they charge you that amount of tax. The income tax which is what we're used to paying, like through your 1040 during tax time, is that's a net income tax. So basically, that one you take your income and you subtract the expenses. With the gross receipts tax, you don't subtract expenses, but you pay a lower percentage. So, for example, with an income tax, you could pay, maybe 20%. And with a similar gross receipts tax, you could pay anywhere from 5% to fractions of 1%, half a percentage point. So one issue with the Measure 97 is Oregon already has an income tax, and they're trying to institute a gross receipts tax on corporations. So basically, they would be getting taxed on the net income they make through the corporate tax or through a pass-through entity is on the income tax, and I can't explain the difference between those, but I don't have time for that. And then they would also get it taxed on their gross receipt tax. So essentially, it's taxing the same thing twice, which is how much you sold. So, for example, if I was running a 7-Eleven and I sold $10 million of stuff, say, but I only ended up making $100,000 worth of stuff, the net income tax would charge on that $100,000 that I made, and then but the gross receipt tax would base it on the $10 million that I sold. But it's taxed on the same line of income, essentially, the same stream of revenue. So like a sales tax, let's take that 7-Eleven example. The sales tax would tax the value of the property that my store sits on. Did I say sales tax? The property tax would tax the value of the store that I sit on. Sales tax would be taxing the customers that bought things from my 7-Eleven. So those would be how all the different taxes work. Now, one thing. So with an income tax, the tax percentage is based on what you make, right? So if you make a lot of money, you get taxed at a higher percentage than if you make less money, you get taxed at a lower percentage. But if I'm a plumber and I make $100,000, or if I'm a lawnmower and I make $100,000, those both are going to get taxed identically under the income tax. So they both have the same percentage applied to them. Okay, now with a gross receipts tax, there's different categories. Well, there should be different categories of what the tax is, because some businesses, if they have a low margin or a high margin, then I think I'm using that term right, high margin, then they can have very few sales but make a lot of money on the few sales that they have. So like, for example, a white collar worker like a dentist or something like that, they could have $1 million, or let's say $300,000 of revenue, but make $200,000 because they have $100,000 in expenses. But if you're selling gasoline, for instance, you would probably have to sell like $10 million to make $100,000, because your gas costs like 90 cents. For every dollar worth of gas you sell, 90 cents of it is your cost of getting the gas and paying the people. So businesses have different, they can make the same amount of money but have radically different amounts of gross receipts. And and in Washington, I've looked at these rates before, and they basically group different industries and they charge different rates for different industries. So if you're a dentist, then you get charged a higher rate. You'll be charged like 4% or 5%. But then if you're selling railroad ties, you get charged or lumber, you're getting charged like 0.5%. It's just like a very, very low amount. So businesses that are selling goods, a lot of raw goods, for example, they tend to have a very low rate. And so when I was reading an article about about Measure 97, and I'm not a Measure 97 expert at all, but one of the things that they pointed out under Measure 97 is the rates. They haven't marked out the rates for different things. The rates are all the same. So Measure 97 applies only to corporations that make over $25 million. And then it applies the rates identically. There's no difference in rate depending on your industry. Now that's a serious flaw. You can't have a gross receipts tax on two industries that are completely. You can't have the same gross receipt rate on two industries that are completely different. You need to have a rate that's appropriate to the industry. Now, and you might be thinking, well, why do you have a gross receipt tax at all? Well, I think an income tax is better because you at least have to make money before you can get taxed. With the gross receipts tax, you could potentially lose money and still have to pay a tax. I mean, which seems unfair to me. I mean, that seems just unfair, regardless, losing money and still paying a tax. So, yeah, I think income taxes would make more sense, but gross receipt taxes work as well. I mean, once you get the rate figured out and kind of get an idea of where everybody's at and how much money they make and all that kind of stuff, it can work. But that's one reason I don't want to vote for 97 is because the because they haven't figured out, as far as I know, they haven't figured out the rates yet, and they'll have to do that. I mean, if it does pass, they're going to have to tweak the rates to make it work. But you shouldn't pass a piece of legislation that isn't already well thought out with all the rates in place. Just like go to Washington and look at what they have and that kind of stuff. So that's the first reason. The second reason that I think it's not good is because it taxes corporations, but not LLCs. This is according to the article I read again. So basically, then you have two businesses in the same area, like two different grocery stores, for example. And if one's organized as a corporation, then they're subject to the tax. But if one is privately held and organized as an LLC, then it's not taxed. And that doesn't make any sense. Why would you impose a severe penalty on one business that's doing the same thing as another business just based on its organization? I think that's patently unfair. I mean, if you're going to impose a tax, you need to impose it on everybody that is doing business in that particular area. So that's another reason I'm not going to vote for it, because if they're going to impose a tax like that, it needs to be uniform on all the different businesses. It needs to be the same, so it's fair, so it doesn't favor one business over another business. Okay, and then just so that I explained all the mechanics of tax. It's just a couple other interesting observations. This one, most of the bills, like the teachers union, like their PAC, they tend to give a lot of money to the different measures in Oregon. This one, actually, it's the non-government affiliated people that actually have given more money. So like Freddy's and Fred Meyer and I think Safeway and Costco, they've all given, I think, 1.5 million. So there's actually quite a bit of money going against this measure, which is unusual in Oregon because we're more of a left-leaning, not left-leaning, fully left and government-oriented state. So it's kind of unusual that the private people would give so much money here. It's usually the other way around. The other thing that's interesting is I think it's going to fail. I think Measure 97 is going to fail. Oregon historically, it's rejected sales taxes, I think 6 times. Like, it's always rejects sales taxes, but they're pretty amenable to other taxes. Like we have a high corporate rate in Oregon, a state corporate rate in Oregon. We have a fairly high state income tax in Oregon. So people don't usually mind raising taxes here, because they're to be more left. I think it's because they're more left politically. But and I'm going to end with this, but one of the things that I've observed that's really interesting is the arguments that are being made by the commercials is basically a supply side economics argument, which is if you raise taxes on these businesses, you're going to end up costing money to the little people that go and buy from it. So basically, if you raise taxes on Freddy's or Costco or Safeway, what's going to end up happening is they're just going to pass that cost along to the consumer. And that is a very true argument. But that argument, and it's been effective, I think, in the advertising. But that argument is always true. Like, that is true of every tax. So like if you go to tax the rich guy, you're going to hurt the rich guy a little bit, but the rich guy is going to pass it along to you. Particularly if every rich guy gets taxed the same amount, so they don't have to. There's no competitive advantage for them. Competitive disadvantage for them to pass the rate along to the consumer. It's a cost borne by everyone, and it's the same cost. So the supply side economics argument, I think, is a very good one that usually people don't listen to, and for some reason they're listening to now. So I don't understand it. But so I mean, really, tax rates affect Like when you just tax the rich or you just tax big corporations, they also affect little people. But for some reason, that's not usually an effective argument, and it is here. I don't know. Anyway, if you enjoyed that, please like and subscribe.